Hello and welcome. Well, 2022 has so far proven to be a volatile year for risk assets, with the MSCI World Equity Index down almost 10% year to date, which is today, the 22nd of February. But while this is a significant drawdown and painful for many to experience, it's not unusual. So let's give it a bit of context before I talk about why we maintain a positive outlook. Well, there have been 20 prior drawdowns of greater than 5% since 1994, and the average maximum loss across these 20 episodes was 15%, which is bang in line with the global equity volatility figure. So if we take the average recovery time per percentage loss from the last 20 global equity drawdowns, we would expect that, well, 5 times out of 10, a 15% drawdown would take 2.5 months to get back to the previous high water mark. 9 times out of 10, the recovery would be expected in under 10 months. And obviously, recovery times from a 10% fall, as we've had this year, would be shorter. And investors anyway have much longer timeframes than these periods of time. So that's the context, and it all really serves to show how volatility and risk are a natural and normal part of investing. Yes, there are always risks lurking around financial markets, and we pay close attention to them. The Russian incursion into Ukraine is a current case in point. Geopolitics are never far away from investors' minds, but by their nature, they're unpredictable. Historically, they don't tend to have lasting impacts on markets. Now, we know how painful it can be for our clients when they see short-term falls in the value of their portfolios. However, we shouldn't lose sight, as I said before, of the many positive signs we see in the outlook for the global economy and markets. On the energy front, there are alternative energy sources which are growing all the time, and even the Canadian oil sands can come quickly back on stream with fracking output, which would likely put a cap on the rise in oil prices. But more broadly, we see economic data continuing to strengthen after the COVID lockdowns, while progress is also being made on cutting the supply bottlenecks as global trade continues to normalise. And that will lessen the pressure on prices later this year, where we're seeing at the moment inflation at 30-year highs in the UK. Now, the services sector are getting back to normal too, and household incomes have been to some extent protected by government furlough policy. So spending power is strong. And meanwhile, the current corporate profit reporting season is providing evidence of ongoing positive normalisation. So within this context, we expect economic and market normalisation to continue, and we maintain a modest overweight in equities and reduced exposure to rising bond yields as our medium-term investment strategy. So we will, of course, keep you updated as things change, and you can read more about volatility and our outlook in the blogs published in Nutmeg on our website and on our app.